Welcome to the Deep Dive. We're here to unpack complex ideas, give you some fresh insights.
That's the plan.
Today, we are tackling something absolutely fundamental if you want to understand any business. The profit and loss account, the P&L. We all see those headlines about company profits, right? But we're going deeper. We want to unravel the story behind those numbers.
Yeah, give you that nuanced view.
Exactly.
And it is a story. The P&L, or the income statement, as you'll often hear it called in the U.S., it's not just columns of figures.
Right.
It tracks a company's financial journey, its successes, its struggles over a set time, like a quarter or usually a full year.
And we're drawing on some expert insights today.
We are. We're using Maria Malone's explanations as a guide. She really helps clarify things, look beyond just the surface level numbers.
Great. So our mission for you today isn't just, defining terms like sales or costs.
No, much more than that.
We want to explore the choices companies make, the hidden costs sometimes, the big decisions that shape that financial story,
Yeah.
all the way from the top line down to the bottom line, the earnings.
So by the end, you'll be able to kind of read between the lines of a P&L.
That's the goal. Okay, so before we jump right into the P&L structure itself, there's a core idea we really need to get a handle on first.
Accruals accounting.
Accruals accounting. Yeah, it sounds a bit technical maybe, but honestly, the logic behind it is pretty straightforward, and it's absolutely vital for understanding what the P&L is actually showing us.
It really is. And what's kind of fascinating about accruals is it aims to capture a company's performance when the activity happens.
Right, not just when the cash moves.
Exactly, not just when money changes hands. Maria Malone puts it nicely. She says, basically, events in a specific reporting period, let's say selling goods or buying supplies, they get recorded in that period.
Okay.
Even if the actual cash, the payment, comes later, or maybe you paid earlier. It's about matching the economic activity to the right time frame.
That makes sense.
Yeah.
So if a company sells something in December, say, but the customer pays in January, under accruals, that sale counts for December.
Precisely, because that's when the economic value was generated, when the sale occurred. It gives you a truer picture of the company's performance during December.
Okay, but that raises a question then. If it's not tracking the actual cash flow day to day, can't that sometimes lead to a difference between the profit shown on the P&L and, the cash the company actually has in the bank?
Oh, absolutely it can. And that's a really important point for anyone analyzing a company.
Yeah.
You need to look at the P&L and the cash flow statement together, really. The cash flow shows the literal ins and outs of money.
Right.
But the P&L, based on accruals, it tells you about the company's profitability. Is the core business model actually generating value during that period, regardless of when the cash arrives?
So it's measuring the economic health, not just the immediate cash position.
Exactly. It accounts for all the economic effort and the rewards of that specific period. It's a more complete performance picture than just looking at the bank balance.
Okay, got it. That sets the stage perfectly. So, with that accruals principle in mind, let's start building this P&L account piece by piece.
Let's do it.
If we're telling that financial story, where does it start? What's the very first line, the top line?
It always kicks off with sales. Or, as you'll often see it in British English, turnover.
Sales or turnover. Okay.
This is simply the total amount of money the company brought in from its main business activities during that period.
Like Maria Malone's examples.
Yeah.
Selling books or magazines or maybe TV advertising revenue.
Exactly. Whatever the company's core operations are, that's the starting point. But straight away, we need to deduct something crucial to see what's left from those sales.
Okay, what's that?
The cost of goods sold, often just called COGS.
Yes, right.
These are the direct costs of producing whatever was sold. Think the raw materials, the labor directly involved in making the product or delivering the service.
So for a publisher, maybe the paper, the printing costs for those books and magazines.
Precisely, the direct inputs.
Okay, so sales minus COGS. That gives us something important, doesn't it?
It does. That gives us the gross profit.
Gross profit.
And that's your first real indicator of profitability. It tells you how much money you're making just from selling your products or services before you account for all the other stuff involved in running the business.
Like rent, salaries for salespeople, marketing, all that.
Exactly. Those come next. Gross profit just looks at the direct profitability of what you sell. It's a critical first check. Is the core transaction profitable?
Makes sense. So running the business involves more than just the cost of the goods. You've got salaries, rent, maybe utilities. Where do those fit in?
Right. After gross profit, we then subtract what are usually called selling and general expenses, or sometimes SG&A, selling, general, and administrative expenses.
SG&A.
These cover all those other operational costs needed to, well, run the business and make those sales happen, but they aren't directly tied to each specific item sold.
So things like office rent, salaries for admin staff, marketing budgets.
Yes, employee salaries in general, rent for buildings, utility bills, advertising costs, all that operational overhead. It keeps the lights on and the business functioning day to day.
Got it. And there's another cost item mentioned here, one that's maybe a bit less intuitive, depreciation.
Yes, depreciation. This one's interesting because, as Maria Malone points out, it is not an actual sum of money paid out in that period.
Not a cash expense.
Yeah.
So what is it then?
It's an accounting method. It's shown in the accounts to reflect the fact that assets like machinery, equipment, even buildings, they wear out over time. They lose value.
Okay.
And eventually they'll need to be replaced. So depreciation allocates the cost of that asset over its useful life. It's like spreading the purchase cost over several years on the P&L.
That's fascinating. So it's not cash leaving the bank today, but it's accounting for the fact that assets are being used up. For a company with lots of heavy machinery, say a factory, how big of a deal is depreciation on their P&L compared to maybe a software company?
Oh, it's a huge difference. And that's a great question because it really shows why depreciation matters.
Right.
For a capital-intensive business manufacturing, airlines, construction depreciation can be a very, very significant expense on the P&L.
Even though no cash is flowing out for it right then.
Exactly. If they didn't account for depreciation, their profits would look artificially high, because they wouldn't be acknowledging the cost of using up those expensive, long-lasting assets.
I see.
It recognizes that the machine is getting older, less valuable, and eventually real cash will be needed to replace it. It's a non-cash charge now that reflects a future cash need.
And the software company?
Well, a software company might have servers and computers, sure, but its primary assets are often intangible. The software code, intellectual property. It'll likely have much lower depreciation expense compared to the factory.
So it directly impacts the reported profit, even if the cash situation looks different.
Absolutely. It's crucial for accurately showing the true cost of operating, especially when long-term assets are involved. It prevents companies from overstating their profitability just because they bought a big machine last year instead of this year.
Okay, that clears that up. So we started with sales, took out COGS to get gross profit, then we subtracted SG&A and depreciation. What does that leave us with?
After all those operational costs are accounted for, we arrive at a really important figure: operating profit.
Operating profit.
Sometimes called EBIT, earnings before interest and tax.
Right, EBIT. Heard that one.
This number is arguably one of the purest measures of how well the company's core business is performing.
Why purest?
Because it strips out the effects of how the company is financed, how much debt it has and its tax situation. It just focuses on, is the fundamental business, the day-to-day operation, making money?
So it's great for comparisons, like comparing two companies in the same industry, even if one has loads of debt and the other doesn't.
Exactly. Operating profit lets you compare their core operational efficiency on a more level playing field. It tells you if the basic business model works before you factor in financing decisions or tax rates.
So that operating profit, or EBIT, that really shows if the engine of the business is running well.
Precisely. It's where the rubber meets the road, operationally speaking.
Yeah.
Think about those two car makers again.
Okay.
One might be borrowing heavily, the other might be sitting on cash. Their operating profit figures tell you who's better at actually designing, building, and selling cars efficiently. The financing stuff comes later.
Gotcha. It's a key indicator of management effectiveness in just running the core business itself.
Absolutely. Many analysts focus heavily on this number for that very reason.
Okay, so operating profit gives us that clear view of the core business.
Yeah.
But as you said, companies don't exist in a vacuum. They borrow money, they pay taxes. How do those factors come into play next?
Right. So moving down from operating profit, the next major item we typically subtract is interest payable.
Interest payable. So the cost of debt.
Exactly. As Maria Malone specifies, this is the interest the company has to pay on money they have borrowed in the form of bonds and bank loans.
Right.
This is where those financing decisions we mentioned really hit the P&L. A company might have a fantastic operating profit, but if it's carrying a huge amount of debt, the interest payments could eat up a big chunk of that profit.
So A company's capital structure really matters here.
Immensely. Subtracting interest expense shows you the impact of those financing choices on overall profitability.
Okay, so operating profit minus interest payable. What does that give us?
That brings us to profit on ordinary activities before tax, which is usually just shortened to pre-tax profit.
Pre-tax profit. Makes sense. So profit before the government takes its share.
Exactly. But sometimes, between operating profit and pre-tax profit, or sometimes factored in around here, you might see another category.
Ah, those unusual items you mentioned.
Yes, exceptional items. Marie Malone mentions these too. They're things that aren't part of the normal recurring business operations.
Like what?
Well, her example is the cost of closing a particular operation. Maybe a factory shutdown or significant restructuring costs. Or it could be a large one-off gain, like selling a piece of land not related to the main business.
And where are they called out separately?
Because they can massively distort the profit figure for that period. If a company has a huge restructuring charge one year, its profit might look terrible.
Right.
But that doesn't necessarily mean the underlying business is failing. It was a one-off event. Separating exceptional items helps you see the ongoing profitability more clearly. As Malone says, fortunately, this does not happen very often.
So you need to look past them, in a way, to judge the regular performance.
Precisely. You acknowledge them, understand them, but you mentally adjust for them when thinking about the sustainable earnings power of the business.
Okay. So after accounting for interest and noting any exceptional items, we have pre-tax profit. What's the final hurdle?
The tax man. The last major deduction is tax. As the source notes, we pay tax on our profits, and in the UK, this is called corporation tax. In the US, it's generally just corporate income tax.
Right. Every profitable company has to pay its share.
Indeed. So you calculate the tax owed on the pre-tax profit.
And subtract that. And that leaves us with
That finally brings us to the profit after tax.
the bottom line.
The bottom line. This figure is also often just called earnings. This is the number that gets reported widely. Company X reports earnings of Y.
That's the one everyone focuses on. But as we've just walked through, getting to that number involves a whole series of steps, calculations, and adjustments.
Absolutely. And understanding that journey from sales down through COGS, SG&A, depreciation, interest, tax is crucial. It tells you how that profit was made and how sustainable it might be. Just looking at the final number doesn't give you the whole picture.
No, it really doesn't. It's the culmination of everything: sales performance, cost control, operational efficiency, financing strategy, even those one-off events.
Exactly. That profit after tax, or earnings figure, represents the total value generated for the company's owners during that period after everyone else, suppliers, employees, lenders, the government has been paid.
Okay, so we've arrived. We have the profit after tax, the earnings. The company made money, but that's not quite the end of the road, is it? What actually happens to that profit? Does it just sit there?
Haha, no, it doesn't just sit there. That's a really critical next step in the story, and it tells you a lot about the company's priorities and its outlook.
How so?
Well, from that profit after tax, those earnings, Maria Malone explains, we usually pay dividends to shareholders.
Dividends. Okay, so payouts to the owners.
Exactly. It's a direct return on their investment, a reward for owning a piece of the company. You'll often see the P&L notes mention the figure for dividends per share.
Right, but you said usually. They don't have to pay dividends.
No, they don't. And this is really important. Malone notes that when business is bad, we may not do this. We may omit, pass, or skip the dividend.
Skip the dividend. What kind of signal does that send?
Oh, it can send a very strong signal. It might mean the company is facing financial difficulties and needs to conserve cash. Or it might mean management sees better uses for that cash within the business, perhaps for reinvestment. But cutting or skipping a dividend is often seen negatively by the market, at least initially.
Because shareholders expect that return.
They often do, especially for mature, stable companies. So the dividend decision is a big one.
So it's sort of a balance then, paying out dividends now versus keeping the money in the company for what? For the future.
Precisely. It's a key strategic choice. As Malone says, naturally, we don't pay out all our profit in dividends. Even companies that pay dividends usually keep some portion back.
And what happens to the profit they don't pay out?
We keep some to invest in our future activities. These are retained earnings or reserves.
Retained earnings, so profit that's plowed back into the business.
Exactly. It's reinvested, maybe to fund research and development for new products, build a new factory, acquire another company, or simply strengthen the balance sheet.
So the decision not to pay out all the profit as dividends, what does that tell you about management's thinking? about their confidence?
It can tell you a lot. Generally, retaining earnings signals that management believes they can generate a better return by investing that money back into the company's own operations and growth opportunities.
Better than the shareholders could get if they just received the cash as a dividend.
That's the implicit message, yes. It often signals confidence in the company's future prospects and a focus on long-term value creation. High-growth companies, for instance, often retain most or all of their earnings because they see so many opportunities to reinvest for expansion.
So retained earnings aren't just leftover profit. They're an active investment in future growth. That's a really important perspective.
It absolutely is. It shows how the company is funding its future ambitions from its current success.
And is there a way to look at the overall profitability, considering both dividends and retained earnings, on a per share basis?
Yes, definitely. That's where earnings per share, or EPS, comes in.
EPS.
As the source mentions, you can look at profitability in terms of earnings per share, EPS, even if some of these earnings are retained and not paid out in dividends.
How does that work?
You simply take the total profit after tax, the earnings, and divide it by the total number of outstanding shares.
Oh, okay.
So it tells you how much profit the company generated for each share of its stock. It's a really common metric used to compare profitability between companies or track a company's performance over time, regardless of how much they decide to pay out in dividends versus retain.
So EPS reflects the total earning power per share, whether it's paid out or kept for growth.
Precisely. It standardizes the profitability measurement on a per-share basis.
Wow. Okay. So that journey, starting with sales, working through all those different costs and expenses, COGS, SG&A, depreciation to get to operating profit, then factoring in the financing impact with interest, dealing with any exceptional items, paying the tax to finally arrive at earnings, and then making that crucial decision about how much to return to shareholders as dividends versus how much to reinvest as retained earnings. It really does tell a rich, complex story.
It absolutely does. It's far more than just that single bottom line number. It's a narrative of operational performance, financial management, and strategic direction.
Yeah, a dynamic picture of value creation and where the company sees its future.
Couldn't have said it better myself. Each line item contributes a vital piece to that overall narrative.
Well, this has been a truly comprehensive deep dive today.
Yeah.
We've gone through the profit and loss account from top to bottom, covered the bedrock principle of accruals accounting,
Crucial starting point.
all the way through to what happens with those final earnings. You, listening, should now be much better equipped to look at a P&L and see beyond just the headlines.
Absolutely. I think the key takeaways are really understanding the flow, how sales become gross profit, then operating profit after deducting operating costs like SG&A and depreciation.
Right.
Then seeing how interest and tax shape the pre-tax and final profit after tax, or earnings. And remembering it's also called the income statement, especially in the U.S.
And critically, understanding the significance of that final step, the split between dividends and retained earnings.
Yes, because that split tells you so much about financial health, strategy, and management's confidence. It's not just an accounting entry, it's a strategic decision. This knowledge really empowers you to assess a company more deeply.
It really does. So here's a final thought. The next time you see a company reporting its quarterly profits, don't just glance at that final earnings number. Think about the journey. Think about the operating profit. How well is the core business really doing? And consider that split between dividends and retained earnings. What is that decision signaling about the company's view of its own future opportunities versus rewarding shareholders today?
Yeah, what story are those numbers really telling you about strategy and confidence?
Exactly. It's all there in the details. And now you have a much better toolkit to uncover them. Until next time on The Deep Dive, keep digging deeper.